Staying with the same home insurer for 5 years can quietly cost you hundreds of dollars, even if they give you a loyalty discount every year. Here is a realistic scenario. A homeowner in Ontario has been with the same insurer for 6 years. Their premium has increased at each of the last 3 renewals. Their insurer offered a loyalty discount every year, and they are still, in all likelihood, paying more than they would be paying as a new customer at a competing insurer. That is not a coincidence. It is how home insurance pricing typically works for loyal customers, and most homeowners have never had it explained to them. I've spent nearly a decade as an insurance underwriting analyst in the Canadian insurance industry. In this video, I'm going to explain exactly why staying with the same insurer tends to cost more over time, what the loyalty discount actually covers, and what you can do about it before your next renewal. Staying with the same insurer is not a mistake in itself. Continuity of coverage has genuine value. A long claims-free history with one insurer can carry weight in underwriting, and switching comes with administrative steps that take time. The issue is not loyalty as a principle. The issue is loyalty as a default, accepting renewal rates year after year without checking whether they remain competitive. That is where the cost accumulates. Part 1. How welcome pricing works. Most home insurers offer their most competitive rates to new customers. A new customer represents new revenue and an opportunity to establish a relationship. Insurers price for that opportunity. The rate a new customer receives is often the lowest rate that insurer will offer for that property. It is designed to be competitive against comparison platforms and brokers who are actively shopping the market. What changes after year 1 is the renewal calculation. At renewal, the insurer is no longer competing for new business. They are retaining existing business. The calculation shifts, and the rate reflects that shift. The loyalty discount offered at renewal is real, but in most cases it does not fully offset the renewal increase applied at the same time. The net result is a premium that rises year over year, and the gap between that rising premium and the rate available to new customers at a competing insurer tends to widen over time. Part 2. The compounding effect. The compounding effect of annual renewal increases is something most homeowners underestimate because each individual increase appears small. A 4% increase on a $1,800 premium is $72. That feels manageable. But a 4% increase applied every year for 5 years produces a premium of approximately $2,190, a cumulative increase of $390 on a policy that may not have changed in any meaningful way. Over the same period, a homeowner who ran a market comparison at each renewal and switched to the most competitive available rate every 2 to 3 years would be paying a rate that reflects current market pricing rather than 5 years of compounded increases. The difference between those two homeowners is not guaranteed. It depends on the insurer, the property, and the market in a given year. But the direction of the gap is consistent. Part 3. What the loyalty discount actually covers. The loyalty discount is typically calculated as a percentage reduction applied to the renewal premium. In practice, the discount and the annual increase partially offset each other, but the increase usually wins. Here is a simplified version of how this often plays out. An insurer calculates the renewal premium for a loyal customer at $2,100. They apply a 3% loyalty discount, reducing the premium to $2,037. The homeowner's prior year premium was $1,950. The net result is an $87 increase. The loyalty discount is real, It saved the homeowner money relative to the undiscounted renewal. But the market rate for a new customer at a competing insurer may be $1,850. The loyalty discount does not make the homeowner competitive with the market. It makes them slightly less uncompetitive than they would otherwise be. Now, here is the part of this that most homeowners have never considered, and it explains why this situation persists, even when homeowners have a broker. Part 4. Why this is rarely explained. Most homeowners do not hear this explained by their broker because the broker relationship itself is subject to the same inertia. A broker who placed your policy 3 years ago and has renewed it twice since has no strong financial incentive to go to market and find you a lower rate at a competing insurer. The commission structure rewards policy placement, not ongoing optimization. This is not a criticism of individual brokers. It is a description of how the incentive structure works. The homeowner who waits for their broker to initiate a market comparison is often waiting for something that is unlikely to happen automatically. Part 5. The switching cost is smaller than most homeowners assume. The most common reason homeowners give for not shopping their home insurance is that switching feels complicated. Cancellation fees, gaps in coverage, administrative hassle. In practice, switching home insurance in Canada is simpler than most homeowners assume. A new insurer handles the cancellation of the prior policy as part of the binding process. There is no gap in coverage if the new policy is timed to start on or before the renewal date of the old policy. The switching cost is real but usually smaller than the loyalty premium that accumulates over several years. Knowing that changes the calculation. Here is the reframe. Loyalty is a reasonable impulse. Continuity has value. But in home insurance, loyalty is a default strategy. Accepting renewal after renewal without checking the market is an expensive habit that compounds over time. The homeowners who pay the least over a 5 or 10-year period are not the ones who switch every year. They are the ones who check the market every year and use what they find as information, either to switch or to negotiate, or simply to confirm that their current rate remains competitive. The comparison costs 3 minutes. The loyalty premium, compounding year after year, costs significantly more. 3 actions before your next renewal. Step 1. Run a rate comparison now, not at renewal. The best time to compare is 4 to 6 weeks before your renewal date. That gives you time to receive competing quotes, go back to your current insurer if you want to negotiate, and switch cleanly if the gap justifies it. The link in the description connects you to a comparison platform that returns multiple Canadian insurer quotes in one session. Step 2. Use the comparison result as leverage. If a comparison returns a materially lower rate from a competing insurer, take that rate back to your current insurer or broker and ask whether they can match it. Some insurers will adjust, particularly if you have a strong claims-free history. Some will not. Either way, you now have information where previously you had only a renewal notice. Step 3. Set a calendar reminder. Set a recurring annual reminder 4 to 6 weeks before your renewal date. Label it Run Home Insurance Comparison. That one reminder, repeated every year, is the difference between a homeowner who pays the market rate and one who pays the loyalty premium. The loyalty trap is not the result of dishonest pricing. It is the result of a pricing structure that rewards new customers more than loyal ones and a renewal process that is designed to be accepted, not questioned. Now, you know how it works, and knowing how it works changes what you do at your next renewal. If you found this useful, subscribe. I publish one of these every week. Everything I cover comes from nearly a decade of working inside the Canadian insurance industry. The comparison link and the free homeowner checklist are both in the description. If your renewal is coming up in the next 60 days, both are worth using this week. See you next week.